Michael Burry is famous for his portrayal by Christian Bale in The Big Short, and he has correctly called every last major stock market crash, including the recent drop many tech stocks have seen, with some down 40, 50, even 60% since last November, which happens to perfectly match Burry's warnings last November about a bubble in the stock market that reminded him of the dot-com bubble of the early 2000s. And he thinks an even bigger crash could be on its way. But this isn't the first time Burry's been right. He successfully shorted the dot-com bubble in the early 2000s. He famously predicted and profited from the subprime mortgage crash that kickstarted the Great Recession. And he even kickstarted the memeable GameStop rise when he wrote several letters to the board in 2019 about GameStop's then wasted potential. But now Burry has issued a new warning. On June 30th at 4:17 p.m., Burry tweeted out that while the S&P 500 was down 25 to 26% and the Nasdaq down 34 to 35%, that was only the first half of the crash, and that we were maybe halfway there to the bottom. And this time the crash won't just be limited to tech stocks, as the entire economy could be hit by a bullwhip effect from the Fed over the next several months. So in this video, we'll be looking back at Burry's recent warnings to uncover what exactly he is seeing that indicates a crash is coming, talking about how we could move from a surface level price crash in stocks to a full-blown fundamental value crash in the near future. And finally, we'll go over the best strategy to protect yourself from Burry's predicted market crash. So hit the like button if you want, and let's start by talking about Burry's warnings about the most recent stock market bubble. So you may not know this, but Michael Burry was originally planning to become a medical doctor, even getting accepted into Stanford's residency program. But he decided to make the switch to investing, first making a name for himself when he correctly predicted and shorted the dot-com bubble in tech stocks in the early 2000s. While everyone else's funds were crashing, Burry returned 16% and 50% in 2 years, resulting in $600 million flowing into his fund, Scion Asset Management, and giving Burry the reputation for calling out hype and speculation in the market whenever he saw it. And Burry's hinted that he sees similarities between today's market and the dot-com crash, where many companies lost 99% of their value overnight. But that wasn't even Burry's biggest prediction. He later made his famous Big Short against the housing market, betting the entire economy would collapse due to a bubble in real estate. And when he turned out to be correct, he ended up making his investors $700 million, while he himself pocketed $100 million when the housing market ultimately collapsed. And more recently, Burry started issuing warning after warning that the stock market was on the brink of collapse in 2021. And while we have seen a substantial drop in the market since then, Burry says that this is only the beginning. So we need to start our story early last year, when Burry started voicing his concerns over the rise of meme stocks like GameStop or AMC, calling for their crash in mid-2021. This is despite the fact that Burry himself actually kickstarted GameStop's rise after he published several letters to their board about the company's then wasted potential in 2019. He also called out stocks such as Tesla, saying enjoy it while it lasts, back in early 2021. And more recently, in April 2022, he defended short sellers of Tesla against Elon Musk, saying Elon was only mad at short sellers because he needed Tesla stock to buy Twitter. And this was a pattern throughout the last couple years, where it seemed like Burry kept getting more and more bold with his predictions and the scale of their potential fallout. He quickly expanded to calling out everything from Bitcoin to EV stocks to software as a service stocks, saying they are like the housing market in 2007. And so far, Burry has been mostly right, with those areas of the economy declining far more than the market in general. Bitcoin, for example, is down 60% year to date. EV high flyer Rivian is down 75%. Meanwhile, the broader market is only down around 20%. But even though Burry's predictions were pretty much spot on, not everyone was a fan. Elon Musk called Burry a broken clock who was always calling for a crash, so eventually he'd be right. And there may be some merit to that, as Burry has called for previous crashes that still have not materialized. Like in 2019, when he thought index funds were due for a crash. Celebrity investor Cathie similarly had some harsh words for Burry, saying he doesn't understand the fundamentals that are creating explosive growth and investment opportunities in the innovation space. Though to be fair, he was shorting Cathie's flagship ARK Invest fund at the time. But setting aside criticisms that Burry is always predicting a crash for now, on the surface it seems that Burry's warning that we were seeing the greatest speculative bubble of all time in all things by 2 orders of magnitude, which he tweeted last year, was actually a correct prediction. After all, the market has dropped since then, which we would expect if there was a bubble. But was the recent decline that we've seen really the the crash that Burry was referring to, if you leave the YouTube echo chamber where everyone talks in superlatives and mostly about high-flying tech stocks, the overall stock market is only in minor correction territory for the year, at down around 20% year to date, which really doesn't seem like it matches the mother of all crashes that Burry has been warning about. And based on Burry's recent tweets, he clearly sees another crash coming for the stock market. So what is it that Burry is seeing that points to potentially an even bigger crash than we saw back in 2008? Well, there are two main drivers that Burry sees that will drive stock prices down, which he calls out in a recent tweet. The first is multiples compression, and the second is earnings compression. Multiples compression is pretty simple, and it's the kind of change that can happen very quickly in the market, which is why it's sort of the first wave in the market crash. Basically, every stock is valued based on some multiple of its earnings, or how much profit the company produces. If you're a private company on a show like Shark Tank, you might get a multiple of 4 to 6 times earnings. So a company that makes $100 million per year would be worth somewhere between $400 million and $600 million in the private equity market. But in public markets like the stock market, things can get a little more fluid. The average price of a company in the public market is between 13 and 15 times their earnings. This is represented by the PE ratio of the stock. But during certain times like bull markets, sometimes this ratio can go much higher than 15, and in economic contractions, it can go a lot lower. If we plot the average PE ratio of the S&P 500, which is just the 500 largest companies in the US over the past 100 years, we get something that looks like this chart, which kind of looks like a stock chart. Now we can clearly see that around 1980, the average PE ratio of the S&P started rising, which I think is due to the rise of high margin technology businesses like Microsoft and Apple, and later companies like Facebook, Google, and Netflix that people just valued more than traditional companies. But if we zoom way into just the last year or so, we can see how the average PE ratio has dropped from around 37 to 19 over the past few years, which represents exactly what Burry is talking about, a contraction in multiples. That means if I had a public company 5 years ago making $100 million per year, it would have been worth around $3.7 billion on the open market. But if I had that exact same company today still making $100 million per year, it would only be worth $1.9 billion. And that 50% drop represents the market crash that we've seen up until now. But that was just a crash in prices. The amount of money being generated by the business hasn't dropped yet. But that's where the second part of Burry's prediction comes in. And this part is a lot more worrying to a fundamentals investor like me. And by the way, if you're finding this valuable, please consider subscribing. Only 5% of people currently watching this video are subscribed, and I'm not putting in any sponsors or anything like that. All I'm asking is you just take a few seconds to hit that button because it really helps out the channel. Thanks. So the second half of Burry's predicted crash will come from earnings compression, which he thinks will be around the same size as the drop that we've seen so far. If that's true, that would take the S&P 500 to a price of around $2,990, or down 37% from its peak. It would bring the Nasdaq down 47% in total, and it would take Tesla down in total 70% from its peak last November, and down another 45% from where it is today. So it's worth understanding why Burry thinks this will happen. The biggest factor in Burry's prediction seems to be his thoughts on the economy in general suffering from the bullwhip effect of the Fed reversing rate hikes, where supply chain issues would impact businesses, which in turn would affect how much money companies make, which would compress the earnings of the businesses, dropping their stock value and hitting all of our investment accounts. So let's break it down and go over how Burry's bullwhip theory works. In response to rising inflation over the past several months, the Federal Reserve has been under pressure to do something to slow the rate of inflation. Their response has been to raise interest rates, which generally slows down the economy as it becomes harder to borrow money, and in turn, that slows inflation's rise. And that strategy normally works really well. But these aren't normal times. The global supply chain is only just now recovering from the effects of the pandemic, when nobody could get supplies and everything took weeks to ship out. Because of this, during the pandemic, many retailers and businesses just started putting huge orders into their supply chains, just hoping that something would get through for them to put on their shelves. But now, those supply chain issues are starting to clear up, leaving many businesses with too much supply coming in. Big retailers like Walmart and Target are reporting their inventories are up 30% after they drastically overestimated demand. And so, in an effort to decrease inventories, they have started cutting prices at many of their stores, which is great if you're looking for a good deal on a make it rain moneymaker with 2.5 stars from Target. But when we expand that effect to the whole economy, we start to see some issues. If everyone starts dropping their prices at the same time to clear out inventory, we might run into the opposite of inflation, called deflation, or at least a slowing of inflation called disinflation. This means we will see a deflationary pulse from companies clearing out supply, which shows up in falling inflation numbers. This then leads the Fed to reverse its decision to raise rates, which in turn restarts inflation, which kickstarts the whole cycle all over again. And this cycle makes it very difficult for companies to forecast demand and how much they should order, leading to excesses and shortages of products, which all eventually falls to the bottom line in lost profits. So instead of a business making $100 million per year, they might only make $50 million per year, and their stock price drops by half again as a result. Ironically, this is a similar prediction to one given by celebrity investor Cathie of ARKK Invest, who has had a long history of disagreements with Burry, which I covered in this video that I posted right before this. But okay, we understand why Burry is predicting another market crash, but now let's go over what we can do as investors to maximize our returns in the coming market. So first off, we should acknowledge that while Burry has made some incredible predictions, he's also made predictions that never actually came true. In a 2015 interview with New York Magazine, Burry said another crisis was looming, going on to say that he thought the whole economy was on unstable ground. But that was 7 years ago, and if you had sold out of the stock market way back in 2015, you would have missed out on around a 75% return in the S&P 500 since then, even accounting for the recent pullback. And you would have missed out on over tripling in value of tech stocks in the NASDAQ index. But even though Burry isn't infallible, it's worth at least having a plan for a market downturn. So let's turn to the advice of arguably the greatest investor of all time, Warren Buffett. Buffett is famous for the phrase, "Be fearful when others are greedy, and greedy when others are fearful." In fact, this phrase is so well known that there are entire websites dedicated to showing where we are on the greed versus fear scale. This indicator from CNN indicates that we are currently in the extreme fear part of the market, with multiple different sub-indicators showing different parts of the market are either in extreme fear or are at best neutral. Interestingly, the Bitcoin Fear and Greed Index put out by alternatives.me is also showing we are in extreme fear right now. So if we trust these two indicators, they seem to show that now is the time to be putting money into investments rather than taking it out. But there's an even better strategy for most investors, and it's espoused by Benjamin Graham, someone who even Michael Burry himself has said that he studies. Dollar cost averaging, or DCA, has been shown time and time again to outperform trying to time the market, or buying the dip. There's this really great article titled "Even God Couldn't Beat Dollar Cost Averaging" that someone mentioned in a comment, which lays out how even if you had perfect market timing and managed to successfully buy each dip in the market, but you held money in cash in the meantime, you would have underperformed simply investing in an S&P 500 index fund every month from 1940 until now. And that is assuming you perfectly timed the dips in the market, which is already a pretty bold assumption. If you were off by just 2 months in your timing of the bottoms, you would have underperformed dollar cost averaging 97% of the time. This is simply because you miss out on most of the market gains while you are waiting with cash on the sidelines to buy in at the perfect time during the dip. So yes, perfect timing will make you money for a few months following your dip purchase, but once you exit the market and wait with all your cash on the sideline waiting for the next dip, you're missing the run up in the meantime. So by simply investing the same amount of money each month into a broad market index fund like VT Sachs, you will outperform pretty much any investor who tries to time the market bottom. And I'm not just saying that, this is the strategy that I personally use, and I've been steadily putting money into the market every single month. This may not be exciting, it may not be flashy, but it's what Warren Buffett recommends, and it's what every study shows works for most people. Now, if you found this video valuable or entertaining, please consider subscribing since we're only at 5% of viewers subscribed right now. Also, don't forget to hit the like button, and I'll see you next time.